Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future.
Welcome to Sterling Insights, Supercharge Your Assets podcast. This is Charles Trakas, guest host here with Grant Daffin, CPA and president of Daffin Financial. How you doing today, Grant?
Doing great. Good to be here. Thanks for having me.
You're welcome. Let's dive right into it. So you're a CPA. How long have you been a CPA? Give me a little bit about your background, how you got to your firm.
Sure. I've been a CPA for 10 years. I was first licensed in Minnesota, then Colorado and Oklahoma. I went to school at Cornell and then graduate school at the University of Minnesota, where I'm based now here in Minneapolis. I actually got into accounting just because I thought it would be easy to find a job. And then I discovered that I was actually pretty good at it. And then ultimately what kind of inspired me to pursue it further was I realized what an impact could have with small businesses and how much value small businesses bring to our economy and our society. So that really stuck with me. And so anyways, once I really started pursuing accounting, decided pretty early on that I would pursue a CPA license. Right out of the gate, I worked for Ernst & Young as an external auditor. I did that for about 3 years in the Tulsa, Oklahoma office and then in the Denver, Colorado office. I also worked for about a year while I was in graduate school as an internal auditor at US Bank here in Minneapolis. I left EY when I was in the Denver office and started to work for a manufacturing company there in Colorado. And I actually eventually managed to make them my first client. And that was really how I got the ball started with my firm. So I had created the entity actually while I was working for this company. I was just kind of waiting for the right opportunity. I ended up representing this company as an employee in a sales and use tax audit. I was really the only person there that knew anything about sales and use tax. So one day I made them an offer to represent them under my firm's name and they accepted. And from there, it just kind of snowballed, got a lot of word of mouth referrals and been building business ever since. And that was back in 2016.
You talk about sales and use tax. I don't believe there's a lot of people still out there that recall that. Let's talk about it. Your company specializes in 4 distinct areas or specific areas, I should say: fractional CFO, fractional income taxes, and again, sales and use tax. Please explain to our audience about each one and how you guys provide value to your clients.
Sure. So starting with the sales and use tax, I'm sure most people know what sales tax is, but where we come into that picture is when we have clients that operate in multiple states, or perhaps they are located in one state, but they sell into many different states. And now they are triggering what's called economic nexus, which is a new concept. It moves away from requiring companies to file and remit sales tax based on physical presence. And now it's more based on just the economic situation, meaning are they selling into another state where they're not physically located? And states now have established laws that address this economic nexus. And most of those laws say one or two things: either if you have $100,000 in annual sales into this state and or 200 individual transactions into this state, then you have nexus. That second piece is really controversial, the 200 transactions bit, because you might have 200 transactions on really small dollar items that, revenue might be a couple $1,000 total. And it's a pretty heavy administrative burden to require a small business. So where we come in is helping them manage their nexus. Number one, typically we start out by doing a nexus analysis to help them determine exactly where do they have nexus. And then from there, depending on the client situation, we work on a voluntary disclosure agreement with whatever jurisdiction they may have nexus in and weren't aware of it for some years. or we just help them register and start filing to become compliant. But I would say our focus is really on those multi-state clients because they're the ones that carry this inherent risk related to economic nexus. The second piece of it is the use tax part, which most people aren't aware that even exists. And the use tax is like this counterpart to sales tax, where if you buy something, just as a consumer, say I bought something from a company, I'm in Minnesota, but I bought something from a company in Colorado, and that company did not charge me sales tax, but they should have charged me sales tax. Believe it or not, it's actually on me as a consumer now to self-assess use tax in place of the sales tax that should have been charged to me. Businesses have the same obligation, and that's where this normally comes up, is a business is unaware that this tax even exists, and they get picked for audit, and they have to produce documentation showing that they were assessed sales tax on all their purchases that should have been taxed. And this is something that almost very few businesses are actually tracking or aware of. And it can be pretty catastrophic if this has been going on for many, many years. And say the real problem, and this is another thing that so many of our clients are just unaware of, is if you do actually trigger nexus somewhere and you're unaware of it, many years could go by. And all those years you were supposed to be filing tax returns, but you didn't. And the statute of limitations never starts running on a tax return that was never filed. So you can end up with many, many years going back, the state going back many years to try and assess tax on you, and then penalties and interest on top of that. And that can quickly become a disaster for a small company that might be, might be struggling already. So those are really our areas of focus when it comes to sales and use tax.
Explain nexus.
Nexus is essentially the term to describe a company's obligation to file tax returns. If you, so like I was explaining with that $100,000 threshold, once you cross that threshold, you now have nexus, and all that means is you now have an obligation, a legal obligation to file tax returns with that jurisdiction. And that same term is used in the context of income taxes. I'm sure you're aware states also have laws that address nexus with respect to income tax, whereas before I was explaining it strictly in the context of sales tax. And with income tax, it has the same meaning, a legal obligation to begin filing tax returns, but the rules are a little bit different. They still have the economic nexus is still, I would say, the core component of each state's laws, but they vary quite a bit in the sense that some states give a bright line dollar threshold of sales that if you go above that threshold, you now have nexus. Some states, though, are much more vague. Some of them will just say if you're doing business in this state, and they don't give a dollar amount. And then you have to go look how do they define doing business, and am I meeting that criteria? So again, on the income tax front, we really like working with multi-state clients because there's a lot of value we can add on this front to help them understand where they have nexus. And there's a planning opportunity there as well, because say we get a new client that's based in New York, which have really high income tax rates, but they're selling, 90% of their sales are to people in Texas that has no state income tax. Well, there's an opportunity there to apportion income to Texas and out of New York to get that into a much lower tax state, right? So there is an administrative burden there. There's a risk component with that statute of limitations not starting on a return that was never filed. But then there's also the other side of that coin is the planning opportunity if you can shift income into lower tax rate states.
And you answered the question because I live in a non-tax state, Delaware, and I was just thinking I'm a company and I'm selling to Maryland that has a state tax, Pennsylvania, New Jersey. I imagine there's a high percentage of business owners that are not taking care of the sales and use tax where
I think
you
that's a
can
fair statement.
definitely provide some value here. So you kind of told us your ideal client is a business owner. I mean, give me a little more demographics of about your ideal client besides someone doing business in multiple states.
Sure. I would say our ideal client is a business that's doing at least 5 million in revenue and has a few employees at least. And I say that we really define that demographic. It's a little bit larger, I would say, than some people would define a small business. I know a lot of other firms I talk to, they're good with clients that are doing 1 million and up. And we'll still take those clients. But the reason I say our ideal client is 5 million and up is because when it comes to our fractional CFO and fractional controller services, we're going well beyond bookkeeping or that sort of routine basic accounting functions on a day-to-day basis. We actually go in and implement internal controls, implement a very tight month-end close process, and do more robust work in that sense and not just categorizing transactions. What we've really discovered are the businesses that are 5 million and up, They really understand the need. They really have a need, I should say, to have a controller and a CFO function, a bit more sophisticated finance and accounting function. And that's a really good fit for us. We don't really do those. We're not really a bookkeeping firm. We focus on those sort of services I was just describing, really more at the controller and CFO level.
Are there any common misconceptions from the business owner?
I like this question a lot because the first thing that comes to mind is just an interesting example, I think. And we used to call our controller service bookkeeping. It had the same definition and same scope of work. We still did an assessment of their control environment and implemented internal controls for them in a month-end close process. But we changed the term from bookkeeping to controller. One, that was more accurate. But to get to your question, when people hear the word bookkeeping, and then they see a price that's anything above $200 a month, their eyes immediately gloss over and they think it's just ridiculous. They think it can just be fully automated, like no touch, no nothing, no human involvement. They have this misconception that it can be completely automated. And I think this is actually a testament to the excellent marketing by software companies that has made them believe that this can be done. And it's just not true. You can automate aspects of it for sure. And I'm sure there are some businesses that are small enough or of a nature that you can automate 90% of it, but that is just not the case with the vast majority of clients that we work with. How, like for the client or something we did, or
Could be a combination. It could be you. It could be them. Because then I'm going to follow up with give me a story that went right.
sure. Well, the one that comes to mind where something went wrong, where the responsibility was shared between us and the client, is actually around sales and use tax. And we had a client that was struggling financially. They were really operating right around break even, but they also were in a situation where they're selling in many different states and had crossed the nexus threshold in many states. At the time, we're helping them try and decide which states carry the highest risk for them specifically. Because of their lack of resources, basically, we needed to prioritize where to register first and how much of that did they want to take on because they didn't always have the cash to pay our fees to do that work for them, right? So I had this discussion with this client over a video call, just like this. He thought he had given us clear instructions to go and register in a particular state. I thought that he had asked us to hold off on that due to budgetary restrictions. And I did not, and here's the lesson I learned, I did not follow up this with an email to say, clearly, here's what I took away from that meeting, here's what my action items are. And because of that, I think it was maybe 2 or 3 years later, they got a letter from that state and this came up, and this client confronted me with this, thinking I was already registered for them and began filing that state. So I learned a hard lesson there because that became a real dispute between he and I had no written evidence, nor did he, to clearly show what we had agreed to. So that was a hard lesson to learn, but a very simple one, which is anytime we have a meeting like that, we need to document clearly with a follow-up email, something in writing to say, here's what we agreed to do.
So give me a good story.
Let's see, a good story. Well, recently, that would be the beginning of 2024, we started working with a manufacturing company that was really struggling financially. They had never really had a CFO or a controller or really anyone with any sort of financial expertise at all. And this company had been around since the early 90s. They had a CPA firm, but all they did was tax returns, annually. But they were struggling and realized they needed someone to help them do financial planning. So we started working with them in the fractional controller and fractional CFO role. It's a really interesting case because this was a closely held family company. And there's another executive in the company that was not family, but is a very close friend. And because of the company's financial struggles, it really got to the point where we had no choice but start discussing who might need to leave the company in order to make it more profitable. We tried many different things before actually taking action on that. And we were actually able to come up with operational strategies for them to increase their profitability that have been working, that are still working. And all it really took was for someone to dig into their operations and understand what would drive the growth of the business. Anyone with the experience to do the sort of data analysis that needed to be done in order to make these determinations. So that's really where we focused, and we were able to help them figure out a couple of simple strategies about how to conduct their field operations, because it's an interesting company that actually, not only do they manufacture their product, but they have to go into the field and install some equipment with their customers at their locations. So there's this huge operational piece of it. But what I'm proud of about this is, one, that those strategies around their operations really helped. But two, we were able to successfully navigate this very sensitive issue around their closely held company and the family and friend that's involved, and actually come to a resolution on that, a solution that is going to, I think, bring the company back into profitability. And my takeaway from that was I hadn't really encountered a situation like that yet where we had this sort of sensitive family situation. And my takeaway from that was I wish I had forced some hard conversations about that even sooner. I was hesitant in the beginning to do that. And, once we did have those conversations, it was fine. But I wish we had done that sooner. And it's working out well. So it is going to be a success story. But that was a challenging one and very interesting because I hadn't dealt with that particular sort of dynamic within a client before.
No, that's a great story. You kept a family-owned business alive.
Hmm.
No, no. So what do you like best about what you do?
I mean, I think that's it. Honestly, I think that's it. Helping these small business owners and their employees, helping these companies survive and thrive, especially like through downtimes, like through COVID. That was a really interesting time for us. I don't think I mentioned this yet, but we're agnostic when it comes to industry for our clients. We like to work with a lot of different industries for various reasons. But helping clients through COVID, it was so interesting to see because we work with different industries. Some clients thrived and some clients really struggled, but we were able to help all of them through that. We didn't lose any clients. None of them went out of business through that. So, when I meet with clients that own a business, they're an entrepreneur. I consider myself to be an entrepreneur with this firm. And so I resonate with them in that sense. And I think that's really what I get a lot of. It feels very rewarding to help small businesses survive and succeed and grow. That part is very rewarding. I enjoy that a lot.
Talking about helping small businesses, are you just restricted to your area in Minnesota, or do you work with everyone nationwide?
No, we're a completely virtual firm and have clients all over the country currently.
Okay, great. We all have challenges. I like to always ask, what is your biggest challenge?
You know, if you had asked me this 6 months ago, I probably would have said recruiting, but we've actually been successful in our recruiting efforts. We put a lot of time and effort into designing a good process for that, and it's worked out well. And we're building a really excellent team. Currently, I think our biggest challenge, and this is really for me, I'm not, marketing is not my expertise. We're trying to grow our firm. We've really only been seriously trying to grow it for the last couple of years. And I think this is true of a lot of accounting firm owners. Marketing and sales is not something they enjoy doing, and it's just not their field of expertise. So I'm trying to, that's one of the, personally, an area I'm really trying to develop in myself and get better at because I've also had some bad experiences with marketing firms that did not do what they promised. And the ones that did do what they promised, it was completely ineffective. And I think it's because they just don't really understand our firm or how to market it. And what this has made me realize is I think only we are going to be able to understand that. So we're really taking that in house and trying to build our own internal expertise on the marketing front. And that's just been a real challenge purely because of the fact that we don't have a lot of expertise in that area currently, and we're building it up. But then also, this is a tough time because there's a lot of economic uncertainty for many reasons at the moment, and our clients are concerned about that as they should be. For that reason, they're very hesitant to commit to a firm like ours, which is a bit more expensive than just a bookkeeping firm. That's been a real challenge. And to take that deeper, I would say specifically the most challenging part about the sales and marketing process for us is just communicating the value that we provide in an effective way because our services are not always something that we can quantify the value around. So it's very difficult to effectively communicate with clients the value that we are delivering through our services on the front end. Once we're hired and we're doing the work, it becomes very clear, like they feel it on a day-to-day basis. But that initial conversations trying to explain to them what the value is, it's difficult, especially for those companies that are less than 5 million in revenue. Clients that have had tax problems, those are not hard to explain the value to. They felt the pain. So they're very much eager to remedy that. But that specifically, the communication of the value has been very challenging. And it relates to that misconception I was explaining earlier about bookkeeping. Like they just often have a lot of misconceptions that are hard for us to break down and get through.
Well, being on this podcast is going to help you get your value, what I call it VPS, value proposition statement. This is what we do. This is why we're different from other, firms or what in our industry. The next thing is, and most important thing is, where can people find you?
I think the best place to find us is our website, daffinfinancial.com. You can reach out to us directly through that website. Obviously, there's contact forms there. All of our contact information is there. Yeah, that's the easiest way to do it. We're on LinkedIn as well, LinkedIn and Facebook, but I would say our website's the best place to find us.
And it's www.daffinfinancial.com.
That's right.
Daffin is D like David, Apple, Frank, Iglo, Nancy.
I and then Nancy. Yes, that's right.
I want to thank you, everyone, for watching or listening to the Sterling Insight Supercharge Your Asset podcast.
Thank you, Charles.
You're welcome.
Thank you for listening to another episode of Sterling Insights, Stand Out and Supercharge Your Assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.